so you're making a ton of money and you're losing hundreds of thousands of dollars every single year of your hard-earned income to the IRS, and you're trying to figure out, I want to buy this short-term rental, but I want to make sure I'm clear on how all the tax stuff works. And specifically, you and I know you're looking for clarity on three things: bonus depreciation, material participation, and cost seg studies, and just making sure you're clear on how do I actually qualify for doing all this. So let's start with the three criteria for taking bonus depreciation as a product of you satisfying the material participation test for the 100-hour short-term rental loophole. So the first thing we're going to start with is number one, property needs to be purchased and placed into service this calendar year. So if it's 2025 or 26 or 27, you need to purchase that thing and get it placed into service this calendar year. Number two, the property needs to actually be ran as a short-term rental. So what does this mean? Well, if you're buying something in February or March, let's say, and you run it as a long-term rental, the average duration of stay for that year might be something around 120 to a 290-day period, because you've got one tenant in there and they're there for maybe 180 days, 6 months out of that year before you evict them. Well, this is why long-term rentals don't qualify for this test. So you'll be averaging, on average, 2 to 3, maybe 4 day stays. You'll have a lot of one-night stays. You might have the occasional 5 to 10, maybe 15-day stay, but the average duration will be 7 days or less, where 99 to 100% of all short-term rental investors just run their property as a short-term rental that way. And then the final criteria is minimum 100 hours of participation, and no less participation than any other one individual. So this is where everybody gets a little bit caught up. I'm going to workshop a couple examples right now. All right, so let's use this example of a couple who's married, filing jointly. We're going to call them Ganesh and Deepthi, and they're going to close on this home, let's say very, very late in the year, December 15th. And let's say it's currently November 2025 right now. So here is the first track of hours we're going to log. It's what does their material participation look like? Let's see how they can get to 100 hours in this shorter period of time in this calendar year of 2025. So Ganesh and Deepthi are going to participate in anything related to the acquisition, the management, or the improvement of their short-term rental business. So what this looks like for, let's say, the month of October, anything related to them researching properties or specifically researching a third-party team that they might work with to support them with the acquisition of their home, even though they're not under contract on a home or they aren't live with a property that they've already purchased, they can reasonably record and log hours that directly contributed to their future short-term rental business, so long as those hours directly supported the acquisition of the property that they eventually purchased. So let's say, for example, they spent around 4 to 10 hours talking to different teams. So maybe they were looking at third-party consulting teams like the B&B Accelerator team, and eventually filtering out those people who weren't going to support them and then filtering in the people who were going to support them. Let's say they spent 2 to 6 hours on their own looking at properties that didn't really make the cut. They didn't go under contract on those. And then maybe they spent another 5 to 10 hours on their own discussing internally what the scope of the business is going to look like, how are they going to run the business, anything related to the specific operations and management of what the business is going to look like. What I would encourage is you probably don't want to log too many of those hours where you suggested I was looking at properties that you didn't end up closing on. I would maybe log these hours. I would maybe log these hours where you're kind of self-reporting, hey, we're talking about the business, we're working on the business. Let's say for October, they end up substantiating they did around 10 hours. They didn't really actually contribute too much to the business because you're very early stage. Something like that might be reasonable. Now, let's say in November, they start working directly with the B&B Accelerator team or any team, or they specifically start hardcore looking at homes, going under contract on a home. Let's say on November 5th, they end up going under contract on a home. Well, for every single week after that until, let's say, maybe around December 15th, which was the example in this scenario. So maybe for whatever reason, it's going to take them 40 days to close on the home. Well, for those 40 days or roughly 6 weeks, they're logging probably on average, which any typical investor will. If it's a household that has 2 spouses, they're probably looking at anywhere from 8 to 15 hours per week, and this is why. So when you're under contract on a home for a transaction that you do end up closing on, there are pretty substantial items that you kind of need to monitor every single week and every single day. For example, you've got a loan product and you're probably going back and forth with a bank or a lender who's getting items from you so that you can eventually get approved for the loan. Same thing with a title company, same thing with an inspection report. So you might be coordinating things with an inspector. You might be reviewing the inspection report. You might be doing your due diligence on the area and determining, hey, based on this inspection report and based on comps, maybe we need to adjust or recalibrate the total seller credit amount that we want to renegotiate. Same thing with an appraisal report. At some point, you're going to get an appraised value of the home and decide, hey, should we try and negotiate this price down with the seller because the home underappraised versus what our offer price was? Or maybe you see that this home overappraised and you silently choose not to share that with the seller and not let them know that you're buying this thing under fair market value. Well, most investors will recognize there's a pretty substantial amount of time that they're directly contributing, and in the absence of contributing those hours to the transaction, that business wouldn't exist. So some people would argue if you're spending around 6 weeks of being under contract on that home and you're doing anywhere from 8 to 15 hours per week collectively between you and the spouse, and you can make a reasonable argument that between the two of you for around 4 to 6 hours per day for each individual, which kind of comes out to 8 to 12, maybe 8 to 15 hours per week. Pretty reasonable that you would be able to log those hours. So you would end up on the range of somewhere between 48 to 90 hours just during that period of you being under contract and then eventually closing on the home. So now that brings us to December, and December 15th rolls around. So you've got the 15th, December 15th, you've closed on the home. Now, what are you typically doing right after you close on a home? Well, you're setting up your utilities, you're communicating with your co-host team, and typically you'll probably be traveling to the property. And typically when you get to the property, you will be there and you will oversee the process of breaking ground on these post-close enhancements. So even if you're working with a general contractor, a landscaping team, a designer, they are going to contribute to the business, but you're probably not a passive investor where you're just going to give these people free rein to do whatever they want at the property. You're still going to collaborate with them. They might be doing the heavy duty grunt work and heavy duty lifting to follow through on the actual work, but you're typically there overseeing and collaborating with them to make sure that they do everything the right way. So if you end up, and in this scenario, let's say it's Ganesh and Deepthi taking this ridiculously drawn airplane. Let's say they show up at the property, and let's say they're there for a 2 to 4 day weekend. Well, when you fly to your business and you're there and substantially participating to an insane extent, you're typically going to be seeing most of those couples, the individuals, logging 10 to 13 hours per day. Or when you multiply that times 2 and you recognize that each individual's hours get to mutually contribute to that total number of hours, this comes out to around 20 to 26 hours per day for that weekend that they're at the property, materially participating. Almost 100% of every waking moment that they're there is 100% focused on actively improving this business. You might be doing things like driving to and from Lowe's or Home Depot. You might be there coordinating with that general contractor or the landscaper or the designer and pointing them in the right direction, constantly overseeing what they're doing. Again, they'll do the grunt work and the heavy duty lifting for maybe the painting or the installation or the assembly or the staging of items that they're working on there. But your contribution is mission critical, because the thesis is if you weren't there and you weren't overseeing these people's work, it might jeopardize the ultimate quality of their work. So therefore, the hours that you're participating are mission critical to the success of this business, and therefore they should be logged accordingly. So now let's say, what would this look like if you did 2 days, 3 days, or a 4-day weekend? So a 2-day weekend might be 40 to 52 total hours. A 3-day weekend might look like 60 to 72 hours. And in this example, a 4-day weekend might look like 80 to 104 hours. So in this example, when we take the collective hours of everything that we did throughout October, November, somewhere in this range, let's say it was 10 in October, plus 50 in November while we were supporting the closing of the transaction. Plus, we can choose literally any of these numbers. All of them are going to work. Say we choose 60 from the month of December. We would see a grand total of, and this is just within maybe a week or 2 weeks of closing on the home in order to get it live, we're seeing that we've comfortably logged 120 hours. And the good news is there is no one individual in this short period of time who's anywhere even close to participating as much as you guys in this business. So I think this is a really clear-cut example of what your substantiation of your hours are actually going to look like if you're closing on a home in a very short period of time with very few days, weeks, or months left towards the end of a calendar year. Now, let's look at an example where you close on a home much earlier in the year, where you're going to probably still substantiate 100 plus and probably 200 plus hours of participation. But now in this scenario, there are going to be more people who have an opportunity to participate at great lengths throughout a longer period in the year. So let's look at example number 2 now. Now let's go through this second example where it's the exact same couple. Let's pretend it's Ganesh and Deepthi doing this entire process all over again. But instead of them waiting until the very end of a calendar year, let's pretend that they do what every reasonable investor should do, which is not wait until the last minute every year, but you can still obviously wait. Say they do this right out of the gate in the beginning of 2026. So let's say in February, March, and April, and just for sake of time, let's fly through this. April, they do about 10 hours, maybe reviewing properties, maybe talking to different teams that they're considering working with, or contractors who might help them on this home, whatever. Let's just pretend they don't even need to log those hours. Let's say they actually start looking at deals in March and then start going under contract on a home. They're maybe under contract for about a week in that period of time. So let's say there's 18 to 15 hours they log. And then in April, they have their closing date, so the close of escrow date, plus the flight to the property, plus they actually spend a 3 to 4 day weekend. And by the end of April, let's say they've launched the property and they've got that thing live. So let's say they've roughly spent around 130 hours in that period of time. Well, now what they're going to need to do in this example is they're also going to need to substantiate that they are participating to some extent pretty much every month, and specifically in some capacity that allows them to substantiate, hey, we're not fully removed from the business, even though we've considerably front-loaded our participation in this business, because now it's April. We started this process of looking for and closing on a home, let's say in February. We went live after we closed at the very beginning of April. We went live at the end of April. So now May, June, July, August, September, October, November, December. What do their hours tend to look like? Well, let's take an example here. So one of the things most investors will spend a considerable amount of time doing, even though they have a co-hosting team, is they'll still spend anywhere from around 2 to 8 hours per week, literally just checking in on their listing in one of 2 different ways. So what most clients end up recognizing is if you have an iPhone or an Android, specifically on iPhone, you've probably seen this useful little tool, which is called the Screen Time app. So this is my example application, and this is what it looks like. What's beautiful about this thing is you get to actually pull up a data set, and it will show you literally every application that you've been on. And for the duration of that day or the duration of that week, it'll show you the exact number of hours that you've been time on task in that application while it's open on your screen. So the beautiful thing is here, we've surveyed clients and asked them to export their screen time usage application stats. And we've recognized most clients spend around 2 to 8 hours per week. That's anywhere from 15 to 30 minutes all the way up into an hour every single day on the Airbnb app. Now, what are you doing when you're opening that Airbnb app? Well, I would make the argument you're not aggressively looking for your next vacation for your family. Rather, you're probably actively overseeing your business, and specifically, you're looking at every message that's going in and out to and from the guests. You're almost micromanaging, if you will, or you're aggressively quality assuring and quality controlling the extent to which your co-host team is actually supporting the guests. So you're reading all these messages, and sometimes you'll open up a feedback loop where you go and coach your co-host team who works directly for you, and you might give insight like, hey, Jimmy, our guest Jeff and his family are a little bit frustrated that they ran out of towels. They came back from a whitewater rafting trip somewhere in upstate Colorado. They drove back to Westminster, Colorado, which is right outside of Denver. And now they no longer have any towels because they used them for the whitewater rafting. Now kids are running around naked in the home. There's no way that they can get clean. They need some support. So you might review that message and ping your co-host team and say, hey, are we on top of this? Are we actually making sure that there's a cleaning team or somebody from your boots on the ground team who's driving over to the property right now with some clean towels? Because they don't have time to wash those towels and dry those towels for the next 2 hours because they've got other activities that they need to get to later in this afternoon. So you substantiating that you're spending 2 to 8 hours per week, and maybe you don't do it as aggressively that much later on in the year. Let's just assume you maybe do that for the next 3 months. So let's say, what does this look like for the next 90 days after you launch the property? So let's say if it's you and your spouse each spending 2 to 8 hours per week, this looks like 4 to 16 hours per week total. And they're going to be around 4.2 weeks in every single month outside of February. So we get roughly 17 to all the way up to, if we do 16 times 4, 64 hours per month, which gets pretty aggressively high. Let's ballpark that somewhere on the lower or middle range. Let's say it's 25 hours per month that you guys can reasonably substantiate. And you do that for 3 months. So that gets you guys another 75 hours. And we're now at April. So let's say we do this throughout all of May, June, and July. So by July 2026, you guys are somewhere in that ballpark range of 130 plus 75. You've now logged 200 plus hours. So here we are thinking, okay, we've doubled the minimum required amount of hours that we need to hit in order to substantiate that we're materially participating in this business. But how do we specifically ensure that it's no less than any other one individual? So let's talk about who those other individuals are, what their hours look like, and how you'll have a high likelihood of making sure that they're not even close to matching your total hour. So let's do a breakdown of the 2 main groups of people who are going to be supporting you throughout your journey. We're going to start with cleaning teams, and then we're going to start with your property management or co-host team. Now, keep in mind, this is no less participation than any other one individual. I repeat, one individual. It's not an aggregate group of people that you're competing with. It's any one individual. So let's look at the hours. Let's say on average, since going live in April in this example, or May or April, whichever one we use. Let's do April, okay? So for the first month and then ongoing, let's say you have 6 reservations per month. That's going to mean 6 cleans per month. And each clean is going to be around, let's get aggressive. Let's say it's 3 hours per clean, right? Well, that means there's a group of people who spend around 18 hours per month in your business, right? Now, let's break this down even further. How many cleaning teams do most co-host companies typically employ? Well, they're going to have anywhere from 2 to 6 different teams that typically rotate in there, because here's the reality of running a short-term rental business. There isn't just one team or one vendor or one individual that you're going to use on every single one of these cleans. Now, most times there'll be multiple teams that people rotate in, not as a product of trying to serve you and make sure there isn't any one individual who's participating to some great extent. Rather, it's just the nature of really good cleaning teams are going to get booked out like crazy. So let's say this gets split across Team A and Team B. So that means 9 hours per month for this one, and then 9 hours per month for this team. Well, each team has different individuals. And let's say for around half of each of those cleans, they have Sally, James, David, and Corey. Now, for each one of these, again, on average, let's say, forget this example where there's somebody who isn't showing up at every single clean. Let's say there's literally just one person who never leaves this team. There's 0 churn, 0 turnover rate, 0 fires that happen in these cleaning teams. So this person spends 9 hours a month at the property. So that's Sally. Let's pretend David show up each time. Well, the grand total of time that any one of those individuals would spend in a single calendar year would be 9 hours per month in this example. And there are, I need to count, April, May, June, July, August, September, October, November, December. That's 9 months. So that'd be 9 hours per month times 9 months, which if my third grade timetables are serving me well, that's 81 hours, right? But let's say, for being even more conservative, let's say there wasn't David doing any of those cleans and it was 100% Sally. So it's 161 hours for that same calendar year. Well, we know that your number was still in excess of this. So here's the good news. The same is actually true with your co-hosting team. Now let's go through their numbers. Now co-host team, let's say you keep 100% of the same co-host team live the entire year. So we got April through December, okay? Now what do co-hosting teams typically look like? Well, there's typically 1 or 2 founders. So there's a guy or a gal or a couple of them who run that business. They have 1 to 2 revenue managers. These are people who spend maybe 30 to 90 minutes per week reviewing your pricing dynamics, making sure that they're jacking up the pricing during peak seasons, they're dropping it during slower seasons, trying to fill all these last minute open slots that haven't been quite filled yet. And outside of the rev managers, there are going to be guest support specialists. There will be client-facing, let's call them account managers. And let's just pretend with this distribution of any hours that they spend in that business, there's one person in here, let's just say, who absolutely loves your business. And let's say they, sun, rain, or shine, they're spending 1 hour per day. 1 hour, literally every business day, which is around 22 business days per month. Let's say 1 hour per day, which would be ridiculous, right? For the span of 8 months in this example, that would be aggressive. But let's say, just for this example, we're doing 1 hour per day, and that's again, all of April through December. So that is 9 months, right? Okay, so let's do the math. That's 22 hours per month. That's 9 total months. And that brings us to a grand total of 198 hours, which again, and I didn't even plan that. I didn't know it was going to be right to the wire. Well, guess what? It's less than what you guys did. So to close the loop on this, you guys need to ensure that you're getting your material participation. I've given you 2 examples of how this looks. Typically in example A, and I didn't even go that aggressively hard with what happens, 100 days plus after you're live with the home. You're still typically checking in with the co-host. They don't really need any input or any ongoing grunt work, legwork, or management work from you. But if you want to continuously substantiate more of your hours, more power to you. You've satisfied the material participation stuff. Some other frequently asked questions around this topic is, do I need to put together a log of my hours and submit that with the IRS? The answer is technically no, but it is a best case practice for you to have that log organized, and most likely you'll do it in January of the following year. You'll go back, you'll watch a video like this, and you'll roughly approximate every single week, what was I doing? So you might come up with a Google Sheet tracker that looks something like 4 columns, a date, an activity name, a duration of hours, and then a notes section. And then every single row might be a 1 week period. So from September 1 to September 8th, that is a row. September 9th to September 16th, that is another row. And in the duration of hours, you'll plug in a number of hours, and in the notes section, you'll substantiate what you were actually doing that week. So your notes section might consistently look like, after you've been live with the property, 12 hours of ongoing support, quality assurance, and quality control with the co-host team. We reviewed every guest message. We made sure that every guest was happy, and we checked in with the co-host multiple times this week to ensure that they were on top of everything. And we caught a couple of errors. We helped calibrate and correct those errors. That was our participation for the week. So you'll typically organize a log, a contemporaneous log of hours that looks like this. And specifically, you will keep that log, but you won't necessarily be obligated to attach that to your returns. That is a log that you will reference if you ever go through what's called a probe, an inquiry, or an audit from the IRS. And knock on wood, as of this recording, we've helped over 220 clients close on over 380 homes in almost the last 4 years. 0 probes, 0 inquiries, and 0 audits. So that is how you will qualify for the 100% bonus depreciation, and that bonus depreciation amount will be dictated by a cost segregation study. Now, a cost segregation study is a third-party team who actually visit the property, take photos of everything, plug all those photos and the dates and the manufacturer numbers or model numbers from any appliance that's in the home and come up with an estimated breakdown of what was the value of each of those items the day they were purchased, what is the remainder lifespan on those items, and if any specific item has an estimated lifespan of 20 years or less left in its current usable lifespan, and there's a chart and a breakdown that the IRS helps dictate these estimated timelines for. They'll accelerate the estimated total value of that amount into year one for your depreciation amount, and you will take that depreciation year one. So for example, let's say you have a $1 million home. Well, let's say you've got to subtract out, let's say you have a $200,000 tract of land right there. That would be an $800K assessed value for the home. What we would see is that cost segregation study might look at everything in the home and then say roughly $290,000 of everything in this home, so around 29% of the purchase price, can be accelerated into year one. So your bonus depreciation amount would come out to $290K. But that's not where the total offset or reduction in your total taxable income comes from. That would be everything that factors into your cost segregation report. Well, there are other items that you can also write off as business expenses on this K-1 income tax return in your Schedule C or your Schedule E that itemizes and lists off all the other expenses that you took in this calendar year from your profit and loss statement, and even things that went into the process of closing on the home earlier in the year. So you're going to be able to write off things like the B&B Accelerator program fee. You get to write off all the amount that you put into purchasing furniture. You get to write off the amount that you paid a designer, a general contractor, a landscaping team, your inspection and appraisal report. You get to write off your closing costs, as those were expenses incurred in association with closing on this property for your business. You get to write off your flights if you took flights to and from the property or even multiple times over. Assuming that this was a business trip, it's not like you took the family on vacation somewhere else nearby and weren't there for business purposes. There's a whole slew of other items that you also get to offset, even things like your co-host team. So if the question is how much bonus depreciation do we typically get to take? Well, in this example, some items like this might sum up to the tune of, let's say, close to like $80,000. You have our program fee, maybe the $30,000 to $50,000 in enhancements you put in post-close, all the stuff you paid your co-host team, especially if you were live earlier in the year, that amount will be pretty substantial. Well, in this scenario, you get to plug in $290 plus $80, and that gets us to $370,000 in total offset. The majority of it came from the cost segregation study, but a pretty beefy amount also came from everything else that you were putting in to actually run this business. So I hope this helps clarify. We would love to work with you. We would absolutely love to work with you. Click around this video. We're going to have other resources that help break down some of the lack of clarity around these topics. I hope you've enjoyed everything so far. Stay on this page or stay watching some of these videos that will link you to, and we look forward to working with you soon.